Alrighty, folks, it's time for that discussion that we had to have. What is better, stocks or real estate? Taylor, if you don't know, is a 12-year Wall Street veteran who will, of course, come down on the side of stocks. I'm somebody who's built his wealth via real estate. And, of course, I will come down on the side of real estate. But let's see what we got. Taylor, you just did a great IG feed on this. So why don't you lay out your base case for stocks over real estate?
Yeah, what's awesome about this is just when someone buys a piece of real estate, for whatever reason, they can forever remember the purchase price of that particular real estate.
Exactly.
Right? True. So the reality is that compounding returns are so powerful that someone can always remember back to, okay, in 1963, I went back and I looked, the longest serving data that comes from the St. Louis Fed takes real estate prices back to 1963. And the average home purchased in 1963 was $19,300.
Wow.
And the average home purchase in the first quarter of this year was $514,200. Wow. Right? And you're like, whoa. So, okay, let me reiterate. So I'll round them off and say 19 grand, 1963, 514,000 today. That is mind-numbing, eye-watering type returns, right?
True.
I'll say wrong. When you actually break that down into what the compounded annual return rate is on that, it's 5.4% per year.
Okay.
So
all right. Well, I have thoughts on that, but I'll let you keep going.
Yeah. So and yeah, we'll go back and forth on this because I see both sides of this coin, but I'll continue in my case here. Sure. Then I start to look at things like, okay, what's property tax? And you could correct me if I'm wrong, but I did a fair amount of research, and property tax is roughly 1% of purchase value per year.
You look across the country. Yeah, sure.
Yeah. Okay, so that's 5.4. Now you're at 4.4. And then maintenance, upkeep, whatever you want to call it, somewhere between 1% and 3% were the numbers that I found. So I called it 2%.
Fair enough.
And so now you're taking 3% annual cost of ownership off a 5.4% return, and you're sitting at a 2.4% real return after expenses. Not real return. Let me be clear. That's not inflation or anything like that adjusted.
Yeah, just nominal. Yeah. Okay.
Yep.
All right.
Let me turn it over to you.
Yeah. So the first thing I talk about, because I get this all the time, if you're on X, there's this chart that's going around that all the stock guys are saying basically that real estate's up, 200% and stocks are up, 500%, right? There's this chart that they both go up into the right, but stocks are the clear winner. And you did the same thing in your analysis. So I will ask you, do you think even back in 1963, when the home price was 19 grand, do you think everybody paid cash for their homes?
No. And that's the thing that I know exactly where you're going with this. It's the leverage idea. So the way I look at this, and so let me give you the other aspect of it, and then we'll go right to that point. So let's talk about the stock side of it. So stocks have annualized from 1963 until today, 10.6%.
Okay.
And 10.6%. So here's the real eye-watering number. So 10.6 compounded $19,000.
Sure.
From 1963 until today is $9.96 million.
Jeez.
So we thought the 514 was a lot. This is 9.96.
Yeah.
So that's the disparity that we're staring down the barrel of as we look at real estate versus stock investments. And I think that I did this video and I laid out all of those numbers and I said, this is pretty clear cut. And I said, look at the caption for the exception. And as far as I've seen dealing with clients now for 15 years or so in my career, most of them of the highest wealth level.
Sure.
I think some folks have made some of the wealthiest folks I know are real estate folks. Unconscionable wealth, right? But I think that is the only thing they do. That is their focus. I don't think they're the onesie twosie. Hey, I got one or two rental properties on the side and think that that's going to make them unconscionably wealthy. Like that's not the reality. It's when you take one and you leverage it into another and you leverage it into another and you leverage it into another. And you could leverage stocks, but no one in their right mind would leverage stocks. It's just too high of a risk asset class to put leverage on top of. But if you intelligently leverage real estate, by all means, that is the way that a lot of folks, some of the wealthiest folks I know, have become wealthy.
Well, you could probably do this math. We're going to put you on. You have a calculator. You have your phone, right? So you can do some
I have
math.
that done. Yep.
All right. So let's see if we can figure out how to do this. So I want to know what the average return is, because right now you're saying 19 to 514 is 5.4%. I have no reason to doubt you. It sounds right.
Nope.
However, again, I would argue that people don't pay cash for houses even in 1963. So if you're going to be buying a home in 1963, I'm going to guess you put 5% down. So 5% of 1900 is, let's call it $500. Just we'll round it off at 20.
Yeah, you're rounding off. Yep, that's fair.
Yeah. So okay, I put $500 down, and suddenly that goes to 514, but we have a basis of 19. So let's call that 500 grand even. Right.
Okay.
Right. We it's really, what would that be? It would be 495,000 or 96,000. So how take $500 and turn it into 496,000 over the course of, what would that be? 62 years. That average return is going to be something substantially higher than 5.4%.
And right, but we're also paying an interest rate along the way to capture that, correct?
Sure. Yeah, of course. Right. But we're just doing net worth at this point, or we're just taking the asset, because you got to live somewhere. If you're not paying that, you're paying rent. So the money's going out the door either way.
Fair. Okay. So our initial investment's 500.
And
number of years.
So that'd be 20, 63.
I'm
call it
putting
62 years, 63 years, something like that.
Yep. Interest rate. Okay, so I don't have my compound return calculator in front of me right here. Give me 1 second. I will grab it.
Oh, look at this guy. Oh, his camera's following him. Now you get to see his setup, folks. This is how we do this here.
Did it follow me out?
No, it did follow you.
Come on back.
What? Yeah, we want to do this. This is fun. See, this is what happens when you do it live. So let's do this together.
Okay. So let's go back to the numbers real quick, because this will do it perfectly for us. So we're 62 years is, and your initial investment is 500, zero payments. Your future value was, what was our future value?
496. 496.
496. 1, 2, 3.
1,000.
Future value, interest rate is 1177.
1177. And
so
stocks was 10.6.
Correct. And let's take off how much are we paying in interest along the way?
I don't know. I mean, again, the interest one is a very interesting thing, because again, you live in your home. So you're going to either pay interest or pay rent. So I'm going to call that a wash. You're going to live somewhere. You're not living in your car.
Okay, that's fair.
Yeah.
That's fair.
Right. Because again, we're assuming this is a home, not an investment property. Because that's what I think, to your point, I really want to talk to.
Also highly dependent upon, okay, let's start to assume now you only put 1% down. You only put 0.5% down. You got 0. We can twist these, but the outright appreciate. I mean, you could margin your stocks. Let's be clear too.
But I want to talk about the average person. This is an important conversation. You're 12 years on Wall Street. I'm 25 years in real estate. I would argue, and you can tell me if I'm wrong, that the average mom and pop, who you and I are talking to today, do not margin stocks. They buy what they have. They buy what they have.
And that was my point before. It's like, listen, they're just too volatile. You should never ever.
Yeah, for the average person. You're not a Wall Street person. You're not doing covered calls and all this other stuff.
Yep.
But
totally fair.
Most people do leverage debt for a home. Most.
Correct.
And that's why I think it's an interesting conversation. And again, I want to be very clear. I don't care which one you choose. I think you can get wealthy in either asset class. You just got to know your thing. You got to know thyself.
Agreed. And I think that when it comes to the real estate side of things, that like I said before, one is scalable without effort. One is not.
True.
Right.
Yeah.
So
that's true.
So you can only buy 1, 2, 3 real estate investments and get that 11% or whatever it is, that 1177, round off 12% that we talked about there.
Right.
You can only do that on a few underlying properties if that is not your only focus.
Correct.
Right? You can
and that's the goal, right? Of one rental at a time, right? The channel you and I talk on, I tell people all the time, just get to 4. Just find a way to get to 4. And to be clear, you're not replacing your income. That's not what I'm doing. All these get rich quick and all this quit your job, burn the boats nonsense. That's not who I am. I'm like, no, your career is your key to the future. Just stack some paper, buy a couple of assets. And then when you're 60 or 65, not only will you have your 401k, your stock portfolio, but now you'll have 3 or 4 assets owned free and clear that somebody else paid for. Now you got options.
And what is there a number? Is the 4 number something special to you, or is that just
4 was special for some time, kind of in my journey when I was going through this. About a decade into it, maybe 12 years, banks stopped lending on real estate, and the max loans you could get were 4, and that just stuck. Now it's 10, right? You can get 10 conventional loans today, but back in 2008 through 2012, maybe 13, you can only get 4. And the other reason 4 stuck, Taylor, is I've asked that question hundreds, if not thousands of times, and everybody thinks they can get 4. And that's why I think it's important.
That mental threshold of saying, hey, this is something you can do. It's attainable. Go get it.
Yes.
And so when you're buying a new property, what are you typically putting down? Is it 5%?
So again, if you're doing it the way I recommend for most people, I think best for most people is to buy an owner-occupied home, which would be 3.5 to 10% down, conventional financing, FHA, and then you move every couple of years. And you don't get your forever home until it's the 5th one. So you move 4 times in a decade, but you end up with your primary and 4 rentals with the best interest rate possible. That's how most people should do it.
And so if you're not doing that, and I'm not willing to bump around my family or whatever it is, and you're looking to buy,
you'd be 20 to 25% down.
That dramatically skews the math, right? That we talked about before.
Absolutely.
Dramatically.
Oh yeah, because we did 5% down.
Yeah. So that's 3 to 4x what it is if you start to back that number out. Of course. So yeah, like at the end of the day, to your point, there's no right or wrong answer to this. My point is that I think that everyone is very comfortable with real estate because it's a tangible asset. And I think that there is some fairness to that, like just being able to see, touch, etc. And full disclosure, like in the downside of a market, when it gets nasty, typically you're going to hold up better in real estate than you are.
Oh, no question. Yeah.
And returns are a function of risk and reward. And typically, if you have a higher risk threshold, your reward is going to be higher over the long term, right? In the short term, who the heck knows? Let me be clear about that.
Yeah. Yeah. Well, the other thing I think about stocks that often gets lost when you have this stocks versus real estate is, and I don't know what you were assuming. I'm guessing you were saying buying an ETF or an index kind of in this analysis. But correct. A lot of people try to do individual stocks, which actually means you have 2 points of errors, right? You got to know when to buy it and when to sell. And, as somebody who got his ass handed to him by fraud, Enron and WorldCom, that doesn't feel good, man. You lose it overnight. And these were audited by the Big Five. They were on the New York Stock Exchange, right? How can these be frauds? Easy. They were. It could happen.
I'll make the argument that it's not one or the other in my mind. It's a combination thereof, because the reason people fail in investing in stocks, and let me be clear that I'm not advocating individual stocks. I do not advocate individual stocks. The reason people fail, broadly speaking, buying even indices, is the fact that they're just too volatile. They get scared. They jump off the ship at the wrong time. Well, if you're looking at a broader financial umbrella of your life, and you have an asset that's real estate that really doesn't move all that much, and you're looking at your broader net worth, it is downside protected, has a floor under it by real estate. And the stock guys will then go back and say, yeah, but you're not selling that real estate right then. If you were to sell it, you'd take a huge haircut on it. It's just the fact that it doesn't matter. You're not selling it then, right? That's the reality of it. It doesn't get whipped around as quickly. So
the other thing I want to ask you on that thread is, it's not only that stocks are more volatile and almost emotional, it's the speed that you can make a decision, right? You could sell a stock in 3 seconds or buy a stock in 3 seconds because you read something, you heard something, you had a bad day, you got drunk. I mean, who knows? You can't do that with real estate, right? It takes days and months, weeks, and appraisals and lending, and it's a lot harder to have a fraud in that because you got all these external parties involved.
And Most of the time that's seen as a negative on real estate. But I see where you're coming from. I also view that with a portion of your assets as a positive, right? Everyone wants access to their money at all times. But what everyone does not want is the other people that own that asset along with them to have access to their money at all times. Because all of a sudden the other holders start to kick out of this thing and you're left holding the bag as it gaps downwards. You don't want that. And so like full disclosure, kind of coming back to what we do and how we invest, a lot of the things that we buy are intentionally less liquid. And we see that as a structural advantage of them, not a disadvantage. Not because you can't, Michael, as our client, take your money out. Like ideally you'd be able to, but nobody else would, right? That's not the reality of it. It's protecting you and the portfolio manager from everyone else bailing out all at once.
Yeah. Again, it's important for me to understand. Again, here's a question. I don't know if you would agree or not with this one. This will be fun. When I look at the basket of stocks and the basket of real estate, and I step back and go, hey, what can I become an expert in and frankly have an unfair advantage? From where I sit, and again, I'm not the Wall Street veteran, you are. I am never going to have an unfair advantage in stocks. I'm not in the inner circle. I don't have quant computing. I don't have all of this stuff. But I can become a fundamental expert on a 5 square block area of real estate and know it better than anybody else. And the other thing is stocks, you always know what it costs, or at least most of them, down to the penny. In real estate, you can always find a motivated seller. You can find odd situations. You can create value. So when I look at this, I'm like, if I'm going to take the time to be in the top 1% of something and get my unfair advantage and my unfair returns and buy better and sell better, in my world, I see it in real estate, but I'm not the Wall Street guy. So what do you think of that?
I think that's fair. I think that the advantage on the other side is there is no work. Like
that's
the
true.
reality.
That's fair. That's fair. Yeah.
the reality is the work. There is work. Let me flip that. There is work. The work is emotional behavior.
Yeah.
Like keeping your emotions under control.
Robot-like.
Yeah. I say it's the only thing that you can make money in over time while doing nothing. You're not lifting a finger. You're not performing any effort. It's not consuming any mental compression of yours. It is able to produce returns over time. Yeah. The cost is the emotional intelligence it takes to stay the course, right?
I don't know if this is true.
Go ahead.
Yeah, I don't know if this is true, but I've heard this. So it'll be funny if a Wall Street guy disagrees. But apparently there was analysis of portfolios. And the best performing individual portfolios were people that were dead.
Doesn't shock me whatsoever. Does not shock me whatsoever.
Because they don't trade.
I have heard that. I mean, the best performing assets that people have are 100% in their 401ks.
Yeah.
Because it's autopilot. It's close your eyes, that invests every quarter, and you never touch it. You never look at it, right? Maybe you look at it once a year or something like that, and you adjust. Their brokerage account assets, man, they often refer to as the stock market, or your portfolio rather, not the stock market, your portfolio like a bar of soap. The more you touch it, the smaller it gets, right? So it's true. The dead people don't touch the bar of soap ever, and so therefore it just
the soap gets, that's amazing. That's amazing. So I guess at the end of the day, where I come down on this, and I've been here for the last couple of decades, is I think the average mom and pop investor, right, full-time employee raising a family, I think they should absolutely be getting company match in their 401k at a minimum, if not maxing it out, but at least get the minimum or the match, right? That's critical to me. And then you should try to find a way, either via house hacking or FHA or whatnot, to get to 3 or 4 properties. And then by the time you're 60 or 65, you should be a multimillionaire in both accounts, your real estate account and your 401k account. So to me, it's not this what is better than the other. I think it's a cute battle, but often comes down to what your personal experience is. And I think they're both. You got to do the work. You got to manage the emotions, and it's not get rich quick. Neither one of these is get rich quick, but they both are get rich for sure.
Agreed. I think that, like I said before, I think they're a combination that's a match made in heaven. One you have to be emotionally intelligent upon. The other one you have to actually do work on. So it's the combination of the two there that's going to help you kind of capture what seems to be better long-term results on the surface level out of stocks, but also your ability to keep your ass in the seat during tough times, because the real estate portfolio has a nice bottom underneath it, whereas stocks are more volatile on the downside.
Yeah, Taylor, you're amazing. You're doing great work for your clients. How can somebody reach out and learn more?
Yeah, so head over to our Instagram or our TikTok page. We talk a lot, 60-second videos every single day, and from there you're a click away from an intro conversation directly with me.
There you go, folks. Let him know on his Instagram. Did he do a good job? Did he do a fair analysis of real estate versus stocks? Let me know. Take care. Later.
Thank you.